but I'd like to introduce Lionel Lee. Lionel is a marketing manager with Chubb. Chubb is an incredible partner and sponsor. Lionel deals specifically with insurance for the affluent market. If your high net worth clients have insurance needs, Lionel is someone you need to speak with. Lionel has a business degree from the State University of New York at Oswego. He's been with Chubb for at least 17 years, so he knows the market and how your clients can benefit from it. So as soon as we're ready, I'll turn the microphone over to Lionel Lee.
Good morning, everyone. As Jennifer said, I'm Lionel Lee. I'm with Chubb Insurance, and it's just an honor to be back presenting to you again. We've been members of the FPA for a number of years, and we continue to go down this path of education and awareness when it comes to personal insurance. And today I have some new material for you today. In the past, you guys have heard us talk about the affluent marketplace, and we're still going to touch upon the affluent marketplace, but today we're going to talk about the younger generation. So they have a few different names: young professionals, affluent or emerging affluent. The most common is millennials, and I heard someone mention, the younger generation with Steve's presentation. So today we're going to take a deep dive into the young professionals. We're going to talk about some of the demographics and characteristics of the group, talk about their attitude towards insurance, always talk about some of the insurance exposures that could lead to a financial loss for them, and then how they look at financial planning and the opportunity that we have together. So quite a bit of material today here, a lot of facts that I'm going to be sharing with you, so you can see how fast we can get through this today. And as always, questions, please don't wait till the end. Raise your hand if something catches you or you have a question. So from an opportunity standpoint, this group really is no different than your affluent customers that you're dealing with. They still have an inherent exposure when it comes to insurance. May not be on the level of, someone who is truly affluent and wealthy, but there is still an exposure that they have that we want to talk about today. And soon, millennials are going to be the largest population. And what's exciting about that is there's just so much opportunity for both of us. You on the planning side, us as, being the affluent carrier in the marketplace. This is the time we want to catch them. We want to catch them when they're young, upcoming, and hold on to them, just like, State Farms and the Allstate seem to hold on to their customers for 30, 40 years. We want to be that same type of carrier to build that long-term relationship with them. So what does this group look like? 53 million people born between 1981 and 1992. And they define millennials as those reaching adulthood between 1981 and 2004. Now, of that group, there are 15 million young professionals that are making $100,000 or more right now. So what's that? That's ages 37. The oldest is 37 down to your mid-20s. So these folks are making quite a bit of money. And surprising statistic is a lot of them do not use financial advisors right now. 40%, in fact, do not use financial advisors. So again, a lot of opportunity for you guys. I don't know how well you can see this slide, but there's a lot going on here. So just a couple things to point out on this slide, starting with the top. Millennials, when compared to Gen Xers, they are just different. They think different, they operate different, and they're into different things. For example, they're 3 times more likely to start up a charitable foundation. I think many of you have probably already seen some version of this, even starting down as low as high school, starting with the gently worn sneakers to send overseas or, gently worn clothes. They have this social consciousness, and they are 3 times more likely to opt out of corporate America and start up charitable foundations. They are also 3 times more likely to start up their own business. They, are young, eager, and, want to, rule the world. So 3 times more likely to start up their own business. That last statistic down there is, they're a little more apt to buy a second home, but really not that significant. And, it's very interesting, one of the comments that prior presenter Steve made in terms of, comparing Gen Xers versus millennials. I'm a Gen Xer, my kids are millennials, and they just have no fear. Like, they feel that everything is just going to be all right, and I'm going to do just fine, and don't worry about it, Dad. I got it under control. Different mindset than where we come from, seeing what our parents came through and how they are where they are. We are Gen Xers a little more conservative, but when it comes to the millennials, they got it under control. Don't worry about it. At least that's what my tube tell me all the time. They are also control freaks. They want to do it all by themselves. They don't need help. I got this, Dad. And it's very interesting, a story I share. I have 2 that are in college right now. And, when you're in college, you go meet with your counselor, to set your schedule. You make sure you're going to graduate on time. And so I'm telling my kids, like, how come you haven't made an appointment with your counselor? I don't need to. Like, I have the whole schedule online. It just tells me what I need to do. I need to take this class this semester. And then, so they don't feel they need to get advice. They don't feel they need to talk to anybody because they can go online and get it, and they just have that, that control that they don't need to talk to anybody. The other thing I'll mention on here is, very, very social-centric. Everything online, everything social media. That is their world. That is where they learn. That's where they get their education. That is their social community. So being social-centric for them is very, very important. Let's talk a little bit about their attitude. What we've learned in the insurance world, and this may reach over into financial planning world, is they are much more willing to take on risk. Again, the forever optimist, I don't need it. It's not going to happen to me. I'm not going to have a loss. What could happen? I'm nobody. I'm, just another 25-year-old. They really put themselves in that category where they just don't think that it's going to happen to them. I think that bleeds over into the fact that they don't have an advisor. Like, they don't feel they need that professional advice. They can just go online and get everything they need and do just as good a job as financial planners. I don't believe that at all, but that's, I think, what their attitude is towards that. And, when it comes to insurance, they really think big. Like, if they don't own a house or they don't own a car, that they feel they don't need insurance. In fact, a lot of them do not purchase insurance if they don't own real property like a house or a car. It's very, very interesting. Let's talk a little bit about some of the exposure. So, again, I go through this segment, a little fear, make you think a little bit, because what they typically think of for insurance in terms of a house and a car, yes, those are important, but there are so many other potential lawsuits, potential claims that if they don't have the proper protection, it's going to eat away at the nest egg that you guys are building for them and developing for them down the road. So let's talk about a few of them here. So millennials, we call them also digital natives. This is the one class that grew up in the internet world. This is what they know. Social media is what they know. And because of that, this group has the highest potential for identity theft. The age group between 20 and 29 is the highest targeted identity theft group out there right now. And even more so with the affluent millennials, because they are probably the most active. They have the most credit cards. They are online shopping. They are a lot more susceptible to identity thefts than, a less affluent millennial. And, it's really not the money. You're going to get your money back from the bank, from the credit cards if someone uses your credit card, or creates an identity for you, using your identity for you. But the thing that folks don't think about is the time and the expenses of what it's going to take to get your credit back in good standing. There is insurance for that, but the banks and the credit cards don't cover that. And again, if you think about a millennial, they're thinking, well, I really don't have, I only have a little bit of personal property, liability, I just have an apartment, what could happen? We're finding that your average identity theft claim is more than a theft out of an apartment. Right now, the average identity theft claim, to get yourself your legal fees, your attorney fees, court filings, time out of work, the average claim right now for identity theft is $4,800. $4,800. That's what it takes that's on average what it takes to get your credit and your name back in good standing. So again, there is insurance out there for that. It is typically included as part of an insurance program, but the trigger is you got to have the insurance. We talked here about the social generation, and here's a few statistics I'm going to give for you. So in 2013, we found that 60% of the mass market, 55% of millionaires, and 52% of ultra-high net worth individuals used Facebook. And again, this is in 2013. This is before Twitter and Instagram and everything has kind of developed. And, as my kids say, Facebook is for old people, Dad. Like, young folks don't use Facebook anymore. Everyone's using Twitter and Instagram. So that number is probably much, much higher right now in terms of individuals using Twitter and Instagram. You have a question?
I was thinking just
Yep.
back on your last thing.
Sure.
That
Yep.
the cost average is
Yep.
$4,800 that's
Yep.
most likely in your insurance.
Yep.
Where would you see that covered in the insurance? The home, the auto, the umbrella? Where is it typically found? Where they would outline that there's identity theft?
Yep. For the carriers that offer it, most of your affluent market carriers are going to offer it, and it's included. You'll see it under your personal liability section. Oh, I'm sorry. The question was, I mentioned that identity theft is included as part of the insurance, and the question was, where do you find it in their insurance policy? Is it under the home? Is it under the liability? Is it under the excess? The answer is it's under your personal liability. Again, not all carriers offer the identity theft coverage. Most of your affluent markets and some of your middle markets are now offering it, but I don't know, I haven't seen it yet. Your standard direct writers do not offer the coverage. State Farm, Allstate, Farmers, USAA, they don't have that identity theft protection in there, but it would be under your personal liability. So you have this young generation that's using social media, and the two big things here is obviously defamation of character, personal injury, libel slander. You have heard of celebrities and individuals getting into what they call Twitter beefs and Instagram, I don't know what the term is, Instagram arguments, I don't know what you call it, but it doesn't take much for you to get on there and start tweeting and posting derogatory comments that could eventually bring a lawsuit, which, again, personal liability will take care of that. I think you all know personal liability. It's legally liable to cover property damage, bodily injury, and personal injury. Again, part of every standard homeowners or renters policy. The one thing I always point out with personal liability is the personal injury. Every insurance company offers personal injury protection. However, not all of them automatically include it. So again, under the personal liability policy, when you're reviewing a customer's insurance portfolio, you want to just do a double check to make sure that they have coverage for personal injury. It's not expensive, it's cheap. Again, most of your affluent markets, your middle market carriers automatically include it, but again, something just to double check, because we have seen cases where it's not automatically included. And again, with this group, again, you have this millennial mindset is, yeah, I see those things happening all the time. People argue all the time on Twitter, but it never happens. And celebrities get into arguments and they sue one another. And then at the end of the day, no lawsuits. It just eventually goes away, which is, it does. But what happens up until that point is a cost. If you get sued, what do you have to do? You have to get an attorney. There's going to be court fees. There's going to be an attorney expenses. All of that is covered as part of having personal liability coverage. So you got to have it to have that protection. Not having it, even if the case turns out or gets thrown out by a judge, you're still going to pay thousands of dollars for an attorney in court fees. So very important to have personal liability coverage. All right, show of hands. How many of you have ever rated a product or service online? All right. How many of you have made a decision to eat, stay at a hotel, go at a vacation place based on ratings online? Yeah, I should raise my hands too. We all do it. We collectively here, calling Gen Xers, might be some millennials in here, but we Gen Xers, what we're finding is while we may not all post as much as millennials, we all use it, but when it comes to millennials, they are very active in posting reviews online about products, services, places they've stayed, and again, just bringing up a point of possible liability, libel, slander, making derogatory comments towards an establishment that impacts their business, and all it takes is to just stretch the truth on something or say something that is incorrect, that you cause a business to lose money because of your comments. If proven to be false, you're going to get sued for libel, slander, loss of wages, income, and you're going to be on the hook for that. So again, it's an everyday thing for a millennial. That's how they make their buying decisions. That's how they help others, make sure they're going to eat at the best places and stay at the best hotel and provide feedback. I don't think they think about the insurance exposure that comes with that. So travel. We've talked about travel. We talk about travel a lot because in our world, the affluent market, the affluent millennials, they travel. They love traveling. They love going to really exotic places. And one interesting fact that I learned from this material is, did you know that the U.S., we bought the second most amount of tickets for FIFA in Brazil. 200,000 tickets were sold in the U.S. to go to FIFA. We were second only to Brazil. And we have a good soccer team, so I guess I could see us, going. But again, it's Brazil. It's exotic. It's different. 200,000 tickets, and I'm sure we all watched the Olympics. And how many of you saw how many people were getting beat up and cell phones taken, and they were getting robbed and carjacked, and you heard some really, really bad stories down there, and that is just traveling to Brazil. This group also travels to very exotic places. Costa Rica, we're going zip lining. We're going to exotic islands. This group, this is how they spend their money. They'd rather go on exotic trips, exotic vacations versus buying that big mansion or that 2017 BMW. So talking to them about travel and travel insurance is very, very important. And there is a product out there in the affluent market that does provide coverage for medical expenses, repatriation expenses, baggage delay, trip delay. There's a lot of add-ons there, but it's providing that additional protection, that additional insurance to cover them while they are traveling out of the country. And yes, I always hear the feedback, well, we have insurance in the U.S., and you do, but understand that that insurance is limited. You know, it's going to afford some coverage, but you're going to come out of pocket some expenses. There's going to be that excess medical expense that isn't covered by your insurance. I don't know many U.S. insurance companies that would pay to medically evacuate someone from Costa Rica to, you know, a facility that can better care for their injuries. So something that we are really, really recommending this product to all of the affluent market, you know, primarily because it's really cheap. I mean, for an individual to buy this type of policy, $170. And that's $170 for 1 year. Many trips as you want to go on. You just can't beat the cost, and it's a nice sleep easy coverage is what I call it. And I use myself as an example. My wife and I are getting ready to go on a vacation, and you know, at the end it says, "Oh, would you like to buy the trip insurance?" And you know, me being the insurance guy, like I said, okay, let me examine this. So for $158, my wife and I had the option to buy travel insurance. And what is their travel insurance is for $158, if I cancel my trip, I'll get my airfare back, but I won't get my hotel money. It'll just sit there, and then I'll have a year to use it, you know, towards another trip, but I have 1 year to do that. No medical insurance, no travel delay insurance, no baggage delay insurance, really not even true trip cancellation coverage because I'm not going to get all my money back. I guess what I'm saying is, you know, when these individuals are purchasing these trips, and I guarantee you some of them are buying the insurance, not many do. I mean, 78% do not buy any sort of travel insurance when they're traveling, which is very concerning. But just something we highly, highly recommend is the travel because of what our affluent market and where they travel. Yep.
Is this then you're saying get it through the insurance company as a separate policy, just like your home and auto, get trip insurance that covers all your trips per year?
Yeah, so the question was, is this a separate policy you buy from your insurance company, or is it added onto the policy? It is actually a separate policy that you purchase. You don't need to have any other insurance to buy this product. It is a standalone monoline product. So $170 for an individual, $365 for a family, unlimited trips. Everyone in the household that travels is covered as part of that program. All right, share and share alike. I won't make you raise your hands again, but I'm sure a lot of you have done this. Peer-to-peer consumption, it's big. This is what the millennials live by. A lot of them, rather than buying secondary homes, are doing the peer-to-peer consumption. Airbnb, VRBO, HomeAway. I think you guys have heard of all of those. Airbnb obviously is the big one that's growing right now. From an auto standpoint, you have Uber, Lyft. You have all of these peer-to-peer consumption models, which are great. You know, it's economical. We're saving some money. We don't have to buy a secondary resident. But the concern is Airbnb, people are renting out their apartments. And from what we know and what our data is telling us, sorry guys, a lot of young professionals do not buy renter's insurance for their apartment. So there's no personal property coverage for if your stuff gets damaged inside your apartment, and they're not buying personal liability coverage. And regardless of who's in your apartment, whatever happens in your apartment, you're on the hook. So damage to the apartment, slip and falls in the apartment, libel slander, getting into fights with neighbors in your apartment building, you, Mr. Renter, are on the hook for that from a liability standpoint. So while it's great, it would be better if they had the protection. And again, I don't think they are thinking about that. They're just thinking, well, let me sublet my place and, you know, get a little money and help pay for the rent, and, it's all good. Same thing from an Uber standpoint. I don't know how many of you are aware, but Uber is basically a vehicle for use. It's not covered under an auto policy. So if you know of people who are driving for Uber, if they haven't already purchased separate coverage for their Uber driving, highly recommend that they get in touch with an insurance agent, risk advisor to talk about that because it's not covered under your personal insurance or your personal auto insurance. I saw a hand in the back. So you said peer-to-peer may not cover your personal. That's correct. Yeah. Oh, yes, you're correct. Yeah, I'm sorry. Yep. So love Uber, love Airbnb. I know my family, we use VRBO all the time. I wonder if they have insurance. They probably do have insurance on that. I've never rented an apartment before, but again, just something worth mentioning when you're doing that profile of your customers and understanding their lifestyles and what they do. You know, if they're engaging in Airbnb and Uber, definitely something worth mentioning. We kind of touched upon this one already, just in terms of rental insurance and the fact that a lot of millennials don't secure renter's insurance. 72% of folks under 30 are currently renting apartments, and 60% of them don't carry insurance right now. So big number. But yeah, just again, another reminder of just how many millennials are living in apartments and how many of them do not have renter's insurance. Auto, another big concern. This product has just been commoditized so bad right now. You guys see it every day, every TV channel. You want to use the gun to name your price, or you want to get online for 15 minutes to save a little money, or you can call the general. The general will probably save you some money as well. But the ongoing theme there is get it for cheap, get it for cheap. You can get it cheaper. I can do it cheaper. You know, come to me, get it quoted here. And what's missing is the big picture is they don't, you know, and the other fact is millennials, they want to do it themselves. So they're not going to necessarily go to a risk advisor. They're going to go online and say, well, why do I need an insurance agent? I can just put this online and name my price. I want to pay $500 and blah, 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 it spits it out and you're good. They truly are missing the ball, because what we are seeing in the insurance world is a ton of state minimum limit policies. The state minimum limit is $25.50 for liability. Absolutely, really low, absolutely horrible. And that was just increased from $20.40 in the prior year. So we did bump it, the state did bump it a little bit. But the millennials, and even Gen Xers for that matter, they really don't know what they have when they're looking at their insurance. And doing it online, how important, and that's just how important it is for them to talk to a risk advisor. We are seeing this on our end because, I don't know how many of you are aware, there's a coverage called uninsured motorists, underinsured motorists that you can purchase. At Chubb, we are seeing the number of uninsured motorist claims just go through the roof. I get loss notices almost weekly of customers who got in accidents, were not at fault, but whoever was at fault had $25,000 limits, $50,000 limits. So those insurance companies, they pay the $25,000 and they're done, and they have no more on the hook. So now it either is going to come back on the customer to pay out of pocket, or, you know, an insured, the not at fault insured or the claimant could look to their policy for uninsured motorist coverage. But major issue happening right now. And, you know, this is an old statistic, but it's, you know, it's the most current one we have because auto accidents take so long to develop. The average accident in 2012 for an actual vehicular injury was just under $300,000. So pretty bad. You know, a $25,000 limit policy is just not going to cover it. Again, we talked a little bit here about spending trends. You know, so the millennials spend their money a lot different than Gen Xers or anyone else for that matter, they're into experiences versus possessions. They're not buying, the big houses. They're not buying the, latest model car. They'd rather buy the newest electronic gadget versus, spending, $25,000 on a Rolex, or they'd rather go on a nice vacation. So they spend money a little different. And what I like to point out on this slide is the last one is their spending versus savings. It's estimated right now that the millennials save about a third of every paycheck. I know I wasn't doing that when I was younger. But just a point to you as financial planners, as financial advisors, they are saving a lot more money than we.
The wording on that is like the opposite.
So they're not, you're right, that is backwards. But the fact is, you're right, they are saving more money. I'll get that fixed. They are saving more money than they are spending, so they are sitting on large lumps of cash. Is it what? Well, it could be, but if you think about it, if they're not spending money on the big ticket items like a large house and the cars, they don't have the big mortgage or the big auto, they will still have money to spend, but they're also going to be sitting on a lot more cash that you or I right now are putting into a house and putting into a car. So they do have, a little more extra liquid cash than I would say me or a Gen Xer would at that age, excuse me. All right. So personal liability, good start. They should have it. Comes as part of your renter's or your homeowner's policy. The problem with personal liability is it's a limit, and there's usually a max. And most of the time, most companies, the max is $500,000. Some you can get to go up to $1 million, but most carriers are going to max out at $500,000. So if you think about, a young up-and-coming millennial or anyone for that matter who's making, some good wages, in the event of a major auto accident, catastrophic event, $500,000 really is not enough insurance, which is where you see the term excess liability. You may have called it umbrella. It's synonymous terms, excess umbrella. Most of the affluent market should carry an umbrella. And there was a survey that was done that they surveyed, and 59% of individuals who had a net worth of $3 to $10 million that in this group that they surveyed were afraid or fearful that they were going to get sued from a major accident or something and get sued for millions of dollars. So 59% of them felt that way, but yet only 13% of them bought the insurance to protect themselves. So this is not really a millennial issue. This is an overall insurance issue. There are a lot of non-buyers of excess liability. Again, it won't happen to me. I have personal liability. I got $500,000. They're not going to sue me for more than $500,000. And that's just not the case. I'm going to take you through some claims examples and show you some of the larger claims that are happening out there. But that number is 12.9% with the Gen Xers. I would imagine that number of purchasing is probably even lower with the millennials. Talking about umbrella, yes. So excess, we call it excess liability, but it's umbrella. They're synonymous terms. Yes. Yep.
Does the insurance industry have a rule of thumb of how much excess liability people should have relative to their income or to their assets?
Yeah, I need to work on this patenting that. I mean, if I could come up with that magic formula, I probably wouldn't be up here presenting to you guys right now. We're going to talk about that a little bit. I have some tips on that, but there is no magic formula. But I do have, 5 or 6 bullet points I'm going to take you through that will help answer that question, or at least allow you to start the dialogue with your customers. This here, I don't have a whole lot of data. We won't spend a whole lot of time on this, but this is just, an example percentage base of where the liability or the umbrella losses are happening and the percentage. So, that 33%, I wish I knew all of what went into that 33%. I just don't have that data. But I'm assuming that 33% is, there's auto in there, which auto is the lead, loss leader when it comes to umbrella. So I'm assuming that is what most of that is. Because rental dwelling has its own class for slip and falls. You got a class separate for dogs, canines, animals. So again, just to give you a feel for the split. I'm going to take you through, 5 or 6 claim studies. Won't necessarily read them and go through all of them, but just give you an idea. These are some really big losses that I'm going to show you. And, everyone always asks, well, what are people purchasing right now, or what's the true loss exposure? And it really does vary. If I had to give you an average, most of the time when we see an umbrella loss, the umbrella losses are typically in that $1 to $2 million range. That's what we're seeing the majority of our claims. Do we have $5 million claims? Yes. Do we have $10 million claims? Yes, I've had some. But on average, so I would say at a minimum, you probably should have your customers at least buy a $2 million umbrella. Our average umbrella for our book of business for Chubb, for new customers coming to Chubb, is $5 million. That's what we are seeing being sold the most by insurance agents. So, I do have to read these, huh? I thought it was up there. Okay, so just going to read a few of these for you. So this one here, after completing his work in the attic of a customer, a heating and cooling service technician fell through the floor of the attic, falling nearly 20 feet. He sustained injuries to his back, hands, foot, rib, shoulder, and wrist. So this was in the state of New York, and the judgment was $8.9 million for this guy, for his injuries. This next one was out in California. While traversing a crosswalk, a woman was struck by an oncoming vehicle. The impact resulted in traumatic brain injury and damage to one leg that ultimately necessitated the above-the-knee amputation. That claim was $26.2 million. This one is Florida. While riding his motorcycle down a highway, a man was struck by a vehicle traveling the wrong way. He sustained multiple fractures, including his arms, collarbone, pelvis, and jaw. The injuries also resulted in infertility, pain and suffering, mental anguish, and lost wages. The vehicle occupants, all minors, were intoxicated at the time and had left a party of the defendant's home where alcohol was being served. $47.5 million. Oops, that was that one. This one was in South Carolina. While riding a motorcycle through an intersection, an individual was struck by a vehicle that ran a red light. The impact caused the man to be thrown from his motorcycle and he passed away at the scene from resulting injuries. The family of the victim sought wrongful death, compensatory and punitive damage from the driver for motor vehicle negligence. South Carolina, $50 million. So again, those are really big claims. I haven't had one that big here in Illinois. I have had some $10 million claims here locally. But again, they do happen. And, the formula, this is probably the best we have for you in terms of trying to figure out a formula. Every customer is different. Every customer's tolerance for risk is different. What you have to do is you have to just walk them through this, or, have them touch base with a risk advisor and insurance agent that can walk them through this and can share experiences of how they handle customers and how they approach what's the right limit. How much they have, what are they investing, what are their real assets, future earnings, which is really big with millennials. These are still young individuals that have, a lifetime of earnings ahead of them. really, really important that they protect themselves now so that if they are brought in, sued and they don't have the proper insurance and it's a really bad accident, all of their future wages could be at risk. So are they set to inherit some money? I know that is happening more and more these days, and millennials are a lot of wealth being transferred to millennials right now. Legal environment, where they live, I know state of risk has a lot to do with limits and what you should have. If it's a litigious state, that could precipitate higher limits. And then who they are, and are they famous? Are they well known? If you were, if someone hits me, maybe not so much, but if they hit, a basketball player or an NFL player, someone who is famous or well known, that will probably result in a higher claim. Questions? All right, so let's talk a little bit about financial planning. Again, I got some stats here, so I'm just going to read these as we talk through. So we've talked a lot already about millennials and the fact that they like control. And what we've learned is if they are an affluent millennial, they want even more control. So right now with the millennials, both of these groups, they like to do their own research online of investments, of mutual funds. They are using the internet to basically help them build their portfolio. However, with affluent millennials, they're actually going to do the research, and they are also more likely to make trades, purchases, buy funds online themselves. Very, very interesting fact that they truly are control freaks in that they are doing a lot of this on their own. And again, we talked about the money and the wealth that they are gaining and making right now. And here, these are along the bottom. I'll just read these to you. 4 times likely to gain wealth from a family business. 3 times likely to gain wealth from their own business. Twice as likely to gain wealth from inheritance. And this is where this number just blew my mind. There is a wealth transfer that's happening right now. It's been going on since 1998, but it's estimated between 1998 and 2052, $59 trillion of assets will be passed on to the millennial generation. Just an obscene amount of money, and it's also very exciting because that's a lot of opportunity for you and I. Here, when it comes to millennials and how they seek out their information, again, we've kind of talked about this a little bit. They are more likely to, all this says basically is they are more likely to want to use online services, online engines for research, possibly doing trades. This is how they get their education and training. So for you as financial planners, having this online, some sort of online platform like this to allow them to get at the information that you are providing would be very, very beneficial because that's what this group is looking for. How am I doing on time? 10, okay, all right, cool, all right. Here's some more stats that I want to share with you guys. So these stats come from Merrill Lynch, and they did a study of these young professionals between 1978 and 1995. And the minimum to be part of the survey is they had to have $1 million of investable assets. 72% of them did it themselves, considered themselves to be self-directed, didn't have any advice or use anyone. They basically went on and did it themselves. Are they doing it right? Maybe. I don't know. I know I couldn't do it by myself, or what I thought, when I would do that type of research, when I would go meet my planner. It was kind of right, but, he made it better for me. So I don't know. Like, that's scary to know if they are doing that. Are they doing it right? Some may. Most probably aren't. Like I already mentioned, they love to seek on online tools. So if you have that ability within your firms to provide that content electronically through social networks, they absolutely love it. The one point that I think is a huge opportunity for you is 49% of them said that they would consider using their parent advisor if given the opportunity. 49%. So, got to get to the parents, basically. I mean, if you are, servicing, the parents, and you have these young kids who are coming into wealth, Jory, you talked about the one this morning that's getting ready to come into an inheritance, getting that introduction from the parents to their kids, I think would be a huge win. Get everyone at the table, let them see what you do from a financial advising, financial planning standpoint. That's the time to get your hooks in them to possibly win them over. And again, once you win them over and you can satisfy their needs from an education and informational standpoint, I truly believe they would be customers for life for you. So, in summary, young professionals are really no different than, the true affluent market that we deal with. There are definitely some gaps in coverage that they either aren't aware about or aren't aware of or are aware of and deciding they don't need to buy insurance. They're going to be fine. They're not going to have any problems. You all have a huge opportunity, and I also like to put that as we, because this is part of what we are doing is the education, the knowledge, giving you guys enough to be dangerous, to be able to point out some of the possible pitfalls and red flags, to get them to talking to an insurance advisor, and really let the risk advisor really help you put a program together to protect them. The last thing we want to see happen is you guys are building these awesome nest eggs for these individuals, and God forbid they don't have the right insurance. Guess where the money is coming from? It is coming from their assets, their nest egg, their retirement planning, the money they have saved for their kids for college. So it's very important that we work together to help you just round out your services, to your customers. So big opportunity for us. Talk to the families, talk to the parents of the kids, get them at the table, talking about insurance, talking about personal risk management. We can, as Julie Joyce and I here, she's here with me today, would love to talk to you outside. We have a network. We have a network of agents throughout Illinois that can help you. Whether it's here in the city, whether it's in the burbs, if you're coming to us from a distance, we have them, as far south as Springfield. So would love to help match up agents to meet your needs. And we're learning. We're going to say we're not the experts in what you do in your field. I mean, I'm still learning every day, some of the things that you guys do from a planning advisor standpoint. But I do know we fit very well together, and it was very interesting with Steve's presentation. There was a lot of overlap in terms of some of the data that he was sharing versus what we're seeing now with the millennial market. So, with that, I just want to say thank you. We have some great marketing material out by the table. I hope you come visit us, come say hello, and I'll open it up for questions. Yes?
You said 1/3 of the money for millennials is going to savings.
Mm-hmm.
Which vehicle are they using, or is it going to them?
Good question. The question was 1/3 of the millennials' money was being saved. Where is it going? That's a good question. Well, we don't know. We're assuming either they're investing it and putting it in funds and doing online trades, or it's just sitting in their bank accounts. That part we're not sure. Yep. Yes. Yep. The question was, does Chubb carry the underinsured as well as the uninsured? And yes, it's a combined form for Chubb. shared, right? Right. So you're gonna have an excess umbrella limit, $2 million, and then you're gonna have a separate $2 million limit for uninsured and underinsured. So that part is shared, the $2 million for the UM. So you got $2 million for the excess, but then there's a separate sublimit for the UM coverage. Yep. Right, and you can, for uninsured motorists, underinsured, I mean, you can purchase 1, 2, 5, sometimes Chubb will go up to 10, but the average uninsured limit is probably between 1 and 2 million. The question is, can you buy uninsured motorist coverage separate, meaning standalone, or do you have to have the home and auto? Speaking for Chubb, we have to at least write your homeowner's insurance. Speaking as the market, most carriers do not provide monoline excess or umbrella coverage. You have to either have the home. Some carriers have the requirement that you have to write the auto with the umbrella, so it depends on the carrier. But you can't buy it monoline. And the next question was a rider on different dog breeds. Yes. Chubb policy, so I have to differentiate because mass markets are a little different, but for Chubb, we do not have a dog list. So if you have a dog, any dog is covered under a Chubb policy. Some carriers have an exclusion list for dogs, primarily direct writers. Yeah, I mean, if I want to expand it, I know you got one coming to you in the back. Just to expand the dog thing, Chubb, also, we don't have any stipulations on pools, trampolines, whereas a lot of your mass markets don't like pools and they don't like trampolines. So again, something else as a talking point when you're talking to your customers about their exposures around their house, and making sure that they have a policy that covers dogs, pools, and trampolines. And all the toys, right.
So the research on the millennials coverage, that is because they're young, don't know any better, or version?
The question was, with the millennials, do they just not know about the insurance, or are they just, like what are you saying, like just confident it's not going to happen to them, or what was the last thing?
Or is it just an aversion?
Just an aversion to insurance? I think it's that personally speaking, just from folks that I've talked to, I think it's that the optimist. Like I only got $10,000 of content. If someone breaks into my house and takes my TV, I'll just go buy, another TV, no big deal. If they break my lock, I'll just go buy another lock. I think they just don't think about the liability side. They think about insurance as it's got to be something real, tangible, like a stereo, a TV, a house, a car. They don't think about the liability. All the stuff online, it's just everyday living for them. Like it's just what they do. None of their friends have been sued, so that that's where the whole optimism comes in. Oh, that's just not going to happen to me. I'll be fine. So I think that's what it is.
It's one of the things with the renter's insurance is telling us about, well, if somebody slipped and fell in your apartment with the medical side, if you don't have basic renter's insurance, you're going to have to pay all that out of pocket.
That's correct.
Me talking about personal liability is a little too nebulous. Give them an example.
Sure.
Of something where, it could be an easy accident, and then they think about the renter's insurance. We had an attorney, this is the son-in-law friend of ours, well, he didn't own a car.
Yep.
He had the same studio apartment, graduated from law school, and he was a partner with one of the law firms, several $100,000 a year, and he didn't have renters or any. It hadn't occurred to him.
Yeah. Yeah, the comment she made was, personal liability as a whole it's pretty big, it's pretty broad. she's saying, you know, narrow it down to something that's more tangible they can understand. A slip and fall in an apartment, you have medical bills that that person is going to need to be compensated for. And you're absolutely right. I mean, most medical personal liability policies include medical expense. You know, limits starting, direct writers are probably starting $5,000, but $10,000 and up for the affluent market. So you're right. If they didn't have that, now they're going to have to pay out of pocket, you know, $10,000 of possible medical payments. Oh, yeah, good point, yep. See, I did help me. This is great. One other comment on the uninsured motorist is, Julie just mentioned, we just recently added coverage for, in the past, in order to get uninsured motorist coverage, you had to own a vehicle, which didn't always work with people who live in the city. People don't have cars. So now with Chubb under our umbrella policy, we automatically include $1 million of coverage at no cost for all related incidences not with a car. So if they are out riding a bike and get injured riding a bike and they get hit by someone who has, you know, minimum $25,000, $50,000 limits, by having that umbrella policy with the coverage built in, now they have coverage that will protect them for their medical bills and everything that they should be getting from the person who hit them but didn't have the insurance. So thank you, Julie.
Would that cover them then if they go to the car in the city?
It would, yes. Yep. Yep. It would. Yep. What is it?
$1 million on the home.
Right, yeah, and yeah, that is just for a bike, but also covering any incidents in the home that's uninsured or underinsured. You got that same limit that would apply to your home. A couple more questions? Go for it. Yeah, the question was disability insurance with Chubb. We do not do disability. Yeah, we are strictly property casualty. Oh, yeah. Probably a good point. Yep. Yep. Yeah, well, that's a good point. Yeah, unfortunately, that's beyond our scope, but. So the question was, you have customers who they own a car, but they're sharing the car with. Oh, the zip car. So that basically is, we call it hired non-owned or borrowed car. Under a personal liability policy, you have 30 days continuous coverage for hired non-owned cars. If they're renting a car from the airport or renting a zip car, you have that coverage is built into the policy. Then it's also covered under the umbrella as well, which could be domestically or it could also cover internationally. If they're traveling internationally, you have an umbrella policy. Now you have rental car coverage in London, Europe, France. So that's how they would have the coverage for the rental car. And the difference with Chubb with the rental car is our rental car coverage and our policy is built into the liability. So it's $1. There's no deductible with Chubb. Yep. Yep. Mm-hmm. Yeah. But if they're renting a car for personal use and they have a personal liability policy with Chubb or any affluent market for that matter, they would go ahead and decline all of those coverages at the counter because they're covered under their personal liability policy. They don't need to buy it. Yep. Which again starts to get into the cost and the benefits of if they're spending, $100 on insurance every time they're renting a car, they do that 5 or 6 times a year, probably better to buy a renter's policy. Now you have rental car coverage for 30 consecutive days, as many times as you want to rent a car. That's another way to justify the reason why they should buy insurance. Good? All right. Thank you, guys.